Welcome back. So we're continuing here with Chapter 7, and in this video, first we're going to look at sort of exchange rates in the real world. We'll see that they don't fall exactly into our three buckets that we've been discussing, but they're very much related. And then we'll look at sort of global capital and why it flows from one country to another, right? We'll think about the international investor and how they decide to buy US government bonds, German government bonds, South African government bonds, Mexican government bonds, and what that means for interest rates and changes in the exchange rate as well. All right, so let's get started. And so first we want to look at sort of exchange rate regimes in practice. And, we've talked about sort of the a common currency area like the Eurozone as sort of our most extreme example of a fixed exchange rate. But that's not how most fixed exchange rates operate, right? Most fixed exchange rates will have their own currency, but will hold its value against either one other currency or multiple currencies. And sometimes they'll say, okay, well, it's this value, but we're going to allow it to change by this much over this amount of time. And so that's a kind of fixed exchange rate, but a little bit different than what we've been talking about. All right, so if we look at this, so basically we're starting here at 12 o'clock and we're saying, okay, well, 4% of the population is in the Eurozone. So that's a kind of common currency area. But remember, it's also kind of a Flexit currency, right? Because the euro itself is allowed to float against other currencies. Then we have what are called dollarized or euroized countries. And so these countries are actually using either the dollar or the euro as their currency. Then we have 12% in other fixed, meaning that they have their own currency, but it's fixed against either, one other currency or a group of other currencies. Then we get into the sort of quasi-fixed world of crawling and managed. And so a crawling peg currency is one where it's fixed at a value, but allowed to change, within a certain amount, right? And so crawling usually means it's depreciating slowly, whereas managed means it could be sort of appreciating or depreciating just a little bit. And so you can see that about half of the world is in some kind of fixed exchange rate regime. Then we have 37%, which the book calls floating, and 12%, which they call free floating. And really the only difference is that the central banks of these floating countries will pay a little bit more attention to the exchange rate when they're setting monetary policy, and they may intervene, briefly in order to smooth out some larger fluctuations of the nominal exchange rate, whereas free floating will not. So if we look, we can see that there's a very strong correlation between the average rate of depreciation. This is against the dollar. So this is 2009 to 2019. That's on the horizontal axis. And the average rate of inflation. And so this is basically just what we were talking about, right? That delta is equal to pi minus pi star, or inflation in our country minus inflation in, say, the United States. And so, countries that had a lot of inflation experienced a lot of depreciation, whereas countries that had low inflation experienced low depreciation. And then there were even a couple countries over here that had appreciation. Now, so Argentina is a common example in macroeconomics when talking about exchange rates. Argentina experienced very high inflation, as you can see. So this is the nominal exchange rate going back from 1960 through 2022 or 3. You can see they had a huge depreciation. Then in 1991, they got a new currency. They introduced a new peso, and they said this is going to be equal to $1. And that worked for a while, right? You can see kind of it worked, but then they had to devalue. That increased the nominal exchange rate. Then the nominal exchange rate was allowed to increase again. And note that this axis, this is a ratio axis, right? This is a log scale. And so it's increasing by 10 each time. And so they experienced again very high inflation. The good news is that the most recent inflation numbers coming out of Argentina have been much lower. So hopefully they are moving to a place where they can have much more macroeconomic stability because they've had many decades of instability. All right. So now let's look at our sort of global financial markets. And when we mean global financial markets, there's just a lot of money in the world that is looking for the highest return. And so that's, savings from people, from companies, all trying to invest in ways that give them the highest return at the lowest risk. So if we think about countries with their own currency, right, then there's going to be a relationship between the country's interest rates and the exchange rates. Because if an investor wants to invest in your country, right, whether it's buying bonds or buying stocks or buying companies, they're going to need your currency. And the only way they can get your currency is by trading their currency for it. That's the exchange rate. And so if interest rates are higher in your country and they want to buy bonds in your country, they're going to have to exchange their currency for your currency, and that's going to affect the exchange rate. Now, one issue is whether or not there are capital controls in a country. Capital controls basically limit how much money can be moved across borders. And so some countries have some significant capital controls. China definitely has some capital controls. Other countries have introduced capital controls, but they're very difficult to enforce. And so we're going to assume that there are no capital controls, which means that money can move freely between countries. So let's think about an example, right? So if we have an investment fund, so say a pension fund, and we have to invest money and get the highest possible return. And so now we have to decide not only between things to invest in the United States, bonds, stocks, etc., but also should we invest in other countries, right? Should we invest in South Africa or Mexico or Turkey? And if we do that, then we also have to think about not only the expected, return and risk in those countries, but also the potential change in the exchange rate, right? Because what we want to do is we want to take our dollars, let's say we were investing in Mexico, we want to exchange those dollars for pesos, we want to buy the investment, we're going to have to wait for that investment to mature, right? Whatever that investment is, whether we're buying Mexican stocks or Mexican bonds or whatever, then we're going to sell that investment. We'll get pesos, but we don't want pesos, we want dollars, so we're going to have to exchange them back for dollars. And so now we have to think about not only, all right, well, what is our expected return in pesos, but what is our expected return in dollars based on potential changes in the exchange rate. So here's an example where we're going to say we're in South Africa, and that's our home economy. And we have to, that's the policymaker's home economy, excuse me. And we're a global investor, and we have to decide whether to invest in South Africa or not, right? And so we're going to say, okay, the U.S. policy rate, the rate that we can get in dollars, is 4%. We're going to call that I star because we're taking the South African perspective. And the home rate, the rate that we can get in South African rands, rand is the currency in South Africa, is 6.5%. So we could say, hey, 6.5% is greater than 4%. We should definitely invest in the South African rand. But the problem is that those bonds, right, are going to take time to mature. And so we'll just say it's a year, right? Now, bonds come in lots of different maturity flavors, right? 3 months, 6 months, 2 years, 5 years, 1 year, 10 years. But we'll just say 1 year. And so as a US dollar investor, we can say, all right, well, I can exchange my dollars for Rand. I can buy the South African bond. In a year's time, I will get my Rand back plus 6.5%, but then I need to turn it back into dollars. And so turning it back into dollars, did I get that 6.5% in dollar terms or did I not? And so if we think about our rate of return in dollars, that's what this R star, RN star is, then it's going to be approximately equal to the interest rate in South Africa, right? That's that 6.5% minus the depreciation rate. And so if we don't expect any depreciation rate, right? If we expect it to be zero, then our return would be 6.5%, right? We would exchange dollars for Rand, get the 6.5%, exchange Rand for dollars at the same exchange rate, and we would be happy. But that can't be the equilibrium, right? It can't be the equilibrium because if everybody was expecting zero depreciation, then everybody would be buying the South African bond and nobody would be buying the US bond. And so what we mean by sort of our equilibrium, right, is that the depreciation must be equal to the difference between the US bond and the South African bond, right? And so in this case, if we expect the depreciation to be 2.5%, that makes sense because then the interest rate for the South African bond has to be the interest rate of the US bond, which is 4% down here, plus the change in the currency, which is 2.5%. So that gives us our 6.5%. So basically what that means is that when we see two different interest rates being offered by different countries, then the global markets must be expecting a depreciation between the country with the higher interest rate and the country with the lower interest rate. Otherwise, it would not be in equilibrium. Now, it's important to remember what expectations actually mean, right? Expectations are our belief about the future, but it doesn't mean that we're always right. And so there will be some people, right, that are saying, well, no, I don't expect a depreciation of 2.5%. I only expect it to be 1.5%, and therefore I'm going to buy the South African bond. And there will be other people that are going to say, no, I think it's going to be like 4%, and so I'm going to buy the US bond. And so there will be people buying both bonds. On average, right, the expectation is that there's a 2.5% depreciation rate, but that just means that some people will be right and some people will be wrong. Some people will make more money, some people will make less money. So this is called the uncovered interest parity condition. And basically it's just saying that the expected return, right, we could say the expected risk-adjusted return, has to be the same in different countries. So if we see different interest rates between countries, then we must know that there's some expected depreciation between those currencies. Now, uncovered interest parity condition is just like, as I said, just like any other arbitrage condition where there will be people who disagree. And so there will be people buying both bonds. And at the end of the year, some will be right and some will be wrong. So does it hold? I mean, it has to kind of hold in equilibrium, right? That has to be true that the differences in interest rates, which are market prices, have to give us the expected depreciation rate on average in the market. But that doesn't mean that it will definitely be that depreciation rate, right? It just means that that's what we expect. That's what the market expects on average over that year. And so I think that's important to remember, right? Like any arbitrage condition, there's going to be some people that make money and some people that lose money. But in equilibrium, the expectations have to be that difference. All right, so we'll stop there, and in the next video, we will conclude looking again at sort of global capital mobility and what that means for countries, especially countries that are, smaller and more open than, say, the United States.